Do you often wonder why some traders make more profit than others, despite having the same resources at their disposal? Puzzling, isn't it? But the answer lies in the realm of trading psychology. It's the mindset, the emotional resilience that sets successful traders apart. Now, let's talk about the 80-20 rule, or the Pareto principle. In trading, it suggests that 80% of your profits come from 20% of your trades. Intriguing, right? The secret to successful trading lies not just in technical skills, but in mastering the 80-20 rule of trading psychology. The 80-20 rule, or the Pareto principle, suggests that 80% of the results come from 20% of the efforts. In the world of trading, this principle holds true in a fascinating way. Believe it or not, a mere 20% of your trades could bring in 80% of your profits. Yes, you heard that right. It's not about making a multitude of trades, but rather focusing on the quality of those trades that truly counts. This is where trading psychology comes into play. It's part of that crucial 20% effort that contributes to a whopping 80% of your trading success. Understanding your own psychological biases, managing your emotional reactions to market volatility, and keeping a level head during market upheavals, are all pivotal to your trading efficacy. Therefore, a trader's focus should be on improving their psychological resilience and emotional control, not just on increasing the number of trades. So, what should a trader take away from the 80-20 rule in trading psychology? The rule tells us that just 20% of your trades can account for 80% of your profits. It's a reminder to focus more on the quality rather than the quantity of your trades. The key is to understand your psychological biases and emotional responses to market changes. It's crucial to invest time and effort in this area. Remember, in the world of trading, it's not the quantity but the quality of your trades, driven by your psychological resilience and emotional control, that truly counts.